Hi everyone. Uh, Thanks for joining us this afternoon on our fixed income seminar. And the title of this seminar is Navigating Rising Interest Rate with Bonds. Before we start with the seminar, I would like to make a disclaimer that this session will be recorded, and any informations that are shared in this session would be purely educational purpose, and you are also advised to do your own financial due diligence. Without further ado, basically I'll brief you on the agenda for today. For the agenda, today we'll start off with what are bonds. This would be more for newer investors who are coming into this asset, bonds asset. And afterwards, we'll be moving on to what is happening to bond yields as of current. Then I'll also be touching a little bit on the banking saga that had happened within these few weeks. Then after that, we'll be sharing on some bond ideas on how you're able to navigate interest rates. And also we'll be ending the session off with Q&A. Yeah. So what are bonds? Bonds are basically debt instruments that provides periodic streams of interest payments to investors. Hence the term fixed income, which can be used interchangeably with bonds. So at the end of the maturity date, for issuers, they are supposed to pay off the principal back to the borrowers. Back to the borrowers. So bonds differ from equities or shares, mainly because equities or shares are traded over the market, whereas for bonds, they are being sold or bought over the counter. So, there are many types of bonds in the market, such as green bonds, senior bonds, perpetual bonds, and etc. But in general, most bonds are being issued by governments or corporates. And why are these bonds being issued? Well, for government bonds, they're mainly issued for project financing, such as building roads, schools, and etc. Whereas for corporate, they issue bonds more on their business expansion needs. So basically, what is happening to bond yields and why are they trending at such a high level as of current? Well, we have to dial back a little back to 2020, when COVID-19 has just started. So when the World Health Organization declared that COVID is a pandemic, there were massive lockdowns being put in place by the governments across the globe, and this is to prevent the spread of the virus. And this have drove demands for goods and services to decline. So on the chart on the right, you're able to see this is the chart for Singapore core inflation. And as you can see, sorry, it's a bit small, but as you can see back in 2020, okay, I'll just read it out. So back in 2020, the chart, right, is roughly showing that inflation for Singapore is trending below 0%. However, as we all know, in 2023, interest rate has rose to the rate of 5.5. So once COVID pandemic has turned into an endemic, borders starts to reopen and consumers are flush with cash currently. So this prompts for revenge spending. And when this happened, demands outpace supply and prices for goods and services rose, which inevitably caused inflation to rise as well. So when interest rate goes up, central banks tend to increase their interest rate in order to tame down inflationary pressures. So in this, when there's a rise in interest rate, right, this causes bond yields to rise as well in recent years. That's why you're able to see the rise in yields for bonds. However, as we all know that bond yields and prices goes in inverse relation. So when yields goes up, bond prices tends to taper down. So on the chart, you're also able to see that similarly to the chart that I've shown earlier, which is the Singapore government's core inflation, US CPI has also showed the same trajectory, whereby initially back in 2020, it's hovering lower than 1%, which is 0 point something percent. And right now it's trending at 6%. So on this chart, you're able to see that this is the Fed funds rate. So yeah. Clear, right? Okay. So on this chart, you're able to see is the Fed funds rate. So back in 2020 to 2022, rates for the interest rates has been hovering around 0.1 range, whereas as you can see until early 2022, which is around the March period, then the FOMC has started to raise its hike cycles. So right now, I think the latest FOMC meeting back last Wednesday, FOMC has raised the interest rate by another 25 basis points, bringing the range to 4.75 to 5%. So on this chart, this is the Fed funds future curve. So what is this curve about? Mainly, it's just an indication of what the markets are expecting for future rate hikes. So as you can see, that market is expecting one more rate hike in May meeting, which after that tends to taper down. So this means that after the May's hike, it will be the peak, and potential cuts will start as early as June this year. However, I think in the latest FOMC meeting, Jerome Powell has mentioned that rate cuts happening this year was not in their base case. So I mean, this so-called like people are expecting rate cuts. Personally, I feel that this rate cuts happening this year is unlikely, which translates that the environment for higher rates and bond yields will be staying on for a little longer, unless there are strong signs of disinflationary happening, such as, because I think there are key indicators such as CPI and PCE indexes. So I believe that if these two index can show continuous reduction, probably 2 or 3 consecutive reduction, bring the levels back to the targeted range of 2%, then we will start to see potential rate cuts. From there. So on this chart, you're able to see this is the 6 months T-bills yield. So, okay, so at this range, right, it's in the year of 2021. So back then, 6 months T-bills were hovering at 0.3% to 0.4%. But right now, I think the latest auction was the cutoff yield in the latest auction was 3.65%. So this has shown that inflation has pushed the yields for bonds to rise even further. So on this slide, which is the 10-year Singapore Government Security, or SGS in short, as you can see, I would like to bring the focus to the 4 circles, the red circles. So as you can see, right, in the first bond, which is 1st July 2023, so this is a 10-year government bond. So if you do minus 10 years from that, so back in 1st July 2013, for the bond that you'll be holding for 10 years, you're only yielding a 2.75%. So on the far right, you can see on 1st July 2031. So this was issued back in 1st July 2021, which, like just now I've reiterated that back then interest rates were trending very low at a period of time. So at a period of time, if you're holding a 10-year bond, it will only gives you a 1.625% coupon rate. Whereas compared to the slides earlier, that showed you that currently 6 months are able to give you a yield of 3.65%. So this has resulted a drop in prices, which is reflected here, because right now 6 months are offering way better rates than 10 years government securities. Okay, so next I'll be talking about Singapore bonds volume as of 29th March today. So year to date, there were 18 corporate bonds that were size greater than of 100 million that were being issued, and these are denominated in our local currencies. So the total amount that was raised from these bonds issuance are approximately 6.3 billion. And this shows that despite the rising interest rates, issuers still have the bandwidth to issue bonds in order to meet their funding needs. So I mean, why issuers are still issuing bonds? Well, because there's a advantage for issuing perpetual structure, because although perpetual structures might be costlier for business, but these debts are treated as equity. Hence, this will not affect their debt levels for the business. So next, I'll be touching a little bit and doing a quick recap on what happened on the banking saga. So first will be Silicon Valley Bank, which is SVB. They fell on the 10th of March. Reason for the run was due to risky capital management. So, I mean, back during COVID period, SVB has experienced exponential growth in deposits, mainly from the tech setup sector. So, I mean, because of this growth of deposits, SVB has put these funds into long-dated government bonds. So back then, government bonds were low yielding, which right now, due to a rising high interest rate environment, these bond prices have fallen significantly. So, I mean, as companies are in need of funding due to the rising interest rate as well, many institutions are pulling out their deposits, which in this case has caused stress in SVB's liquidity. So this has resulted in the bank to sell a portion of their government bonds at a loss at approximately $1.8 billion. And this has caused further panics in the market, which inevitably are leading to a bank run. However, I think on Monday today, First Citizens Bank, North Carolina Bank have announced that they are currently in the talks of buying over SVB. So, I mean, more clarity on this matter will be released later on this week. So moving on to the incident on Credit Suisse. So, I mean, UBS has announced the takeover of Credit Suisse on 19th of March this year. So through this takeover, Credit Suisse AT1's bonds were being written off. So, I mean, the written off for this AT1's bonds were due to discretionary decision from the Swiss government and not the CET1 trigger that is in place for these bonds. So a rough history for Credit Suisse, they have been making consecutive losses in their financials for the past 2 years, and this has already shown material weaknesses in their financials. So, I mean, within Credit Suisse AT1 bonds, there are triggers for a full or a partial write-off. It's when CET1 ratios for Credit Suisse falling below the range of either 5.125% or 7%, depending on the AT1 bonds itself. However, back in financial year 2022, Credit Suisse CET1 ratio are still at a healthy level at 14.1%. So this is like more than double of the trigger. So, I mean, like I've mentioned earlier, the write-off was due to the discretionary of the Swiss government, or FINMA in short, which they deemed that the issuer to be illiquid. So in this case of the buyover, although the Credit Suisse equity holders will be receiving 1 UBS share for every 22.48 Credit Suisse share that they hold currently, this is quite an irony because in terms of repayment structure, bond holders are supposed to be ranked above equity holders. But in this case, equity holders are getting something in within the bought over. So this allows the AT1 bond holders to take the full brunt of the whole entire write-down. So, I mean, there's also another information which more on our local shores, which is on the 22nd of March 2023. MAS have released statements stating that equities holder will absorb losses before the holders of additional tier 1s and tier 2 capitals. So this means that MAS acknowledge that they will be honoring the repayment scheme in our local shores. Okay, next I'll be sharing some ideas and bond ideas regarding how we are able to navigate through this interest rate environment. So the title of this idea, I call it a rejuvenation in hospitality as travel resumes. So the first bond idea I'll be sharing will be on hotel properties 3.8% senior bond that will be maturing on the 2nd of June 2025. So this is a senior unsecured bond which still have an approximate of 2.2 years till maturity. So the indicative pricing for this bond currently is at 98.6, and it gives you a yield of 4.47%. So benchmarking it against the SGS that will be maturing in 1st of June 2025, the yield spread for this bond as compared to the SGS will give you around 152.36 basis points. So why hotel properties? Well, hotel properties are showing a stronger performance by their groups, hotel and resort, due to the reopening that I've mentioned earlier. So this is shown in their revenue, where it has rebounded 52.7% year on year. And this is also seen in their cash flow from operations, where 56.6 million in FY 2021 has increased to 147.9 million in FY 2022. And also back in 20th December last year, Hotel Properties has stated that they will be disposing their 7 units that they own in Ming's Arcade for approximately $61 million. So, I mean, this sell-off that will be taking place earlier this year, if I'm not mistaken, it's in May. This will further boost the liquidity for the company. So in terms of leverage, hotel properties leveraging remains adequate with a debt to equity ratio of 75.3% in FY 2022. And interest coverage for this company has improved to 1.91 times due to higher earnings. So, I mean, with COVID-19 being generally regarded as an endemic now, and the reopening of borders, I believe that hotel properties would be well positioned to capture the recovery. So, I mean, for an alternative for investors that has a longer time horizon, they are also able to look at hotel properties 5.25% senior, which was issued earlier this year. And these bonds will be maturing on the 9th of March 2028. The indicative pricing for this bond is currently at 100.5, which gives you a yield of 5.132%. So moving on to the next one, which is CapitaLand Ascott Trust, 5% senior bond, which will be maturing on 18th of May 2026. So, I mean, for this bond is giving a coupon rate of 5%, and CapitaLand Ascott has a credit rating of BBB-, which is still within the credit which is still within the investment grade credit rating. Yeah. So the indicative price for this bond is currently at 102.4, which gives you a yield of 4.1%. So benchmarking it against like I mentioned earlier, the SGS bonds that will be due in 1st of June 2025. This will be giving a yield spread of 122 basis points. So why do I like CapitaLand Ascott Trust? Well, I mean, for CapitaLand Ascott, their revenue streams comes from a mixture of fixed and variable income. So this gives them the ability for upside potentials recovery, and there's a downside protection. So in terms of revenue, CapitaLand Ascott revenue has rose by 58% year-on-year, attributable from stronger performance from its existing portfolio due to borders recovery. So secondly, for CapitaLand Ascott, their revenue per unit, their RevPAR in short, increased by 78% year-on-year, which I think at the moment is at 155 versus back in 2019 pre-COVID levels, which is at 151. So this shows that RevPAR have already gone back to pre-COVID levels. Occupancy rates for CapitaLand Ascott for their longer stay assets in general, are more than 95%, and student accommodations for the academic year of 2022 to 2023 is at 99%. This is higher than the 95% which was reported previously in the academic year. And I think Ascott has also mentioned that they will be increasing their longer stay they are putting more efforts into their longer stay assets. So in FY 2022, they have increased their longer stay assets allocation from 16 to 19%. So in terms of refinancing, for Ascott, their gearing is at 38%, which gives them a debt headroom of 1.8 billion. Because I think for REITs, they have a gearing limit of 50%. So from 38% to 50%, this 12% gives them a 1.8 debt headroom for them to play with for any refinancing needs. So in terms of interest coverage, well, CapitaLand Ascott has an interest coverage of 4.4 times, and 78% of the debts are fixed, which approximately most of the debts are at 1.8%. So, I mean, for CapitaLand Ascott, because of their fixed and variable income streams, it gives clear income visibility for longer stay properties while having the ability to capture any upsides for its properties with variable rents components. So, I mean, for bigger risk appetite investors, CapitaLand Ascott 3.07 perpetuals are also mentioned, and their next callable date is 30th of June 2023. But do note that this bond is non-cumulative. What does non-cumulative means? That is that the issuer can choose not to pay the coupon rates and on the subsequent coupon payment, they don't have to honor the previous coupon rates. Yep. And these bonds comes with a dividend stopper to give some assurance that, you know, bonds will be paid out first before equity holders or before their REITs holders. So the reset date for this perpetuals, like I mentioned earlier, it's on 30th June 2023. 30th June 2020 and every 5 years thereafter. And the reset rate for this perpetual would be 5 years SOR plus 2.5%. And the indicative pricing for this perpetual is currently at 91.625, which gives a yield of 5.9%. So, I mean, as of current, the 5 year SOR is at 3.14%. Yep. And last but not least would be Fraser's Property 4.98% perpetual, which are callable on the 11th April 2024. So these bonds are junior subordinated and they are cumulative. So issuers will have to honor if they choose to skip this times around the coupon payment. And for these bonds, the reset date would be on 11th April 2024 and every 5 years thereafter. And the rates will be resetted at 5 years SOR plus the initial margin of 3.04% plus a 1% step up. So indicatively, if there's a reset, it will be around the 7% range. So indicative pricing for these perpetuals are at 99.027 and giving a yield of 6.059%. So benchmarking it against the 1 year T-bill, which will be maturing in 30th January 2024, it gives a yield spread of 226 basis points. So why Fraser's Property? Well, Fraser's Property has a sustainable earning growth, which revenue has went back to pre-pandemic level, which revenue has increased 3% year on year, because in FY 2022, revenue recorded was 3.87 billion versus 3.79 billion back in financial year 2019. And in Fraser's Property revenue pipeline, approximately 2.6 billion worth of unrecognized revenue were recorded. And this provides earning visibility for the next 2 to 3 years' time. So in terms of liquidity position, Fraser's Property has approximately 2.4 billion worth of debts that will be maturing this year. But not to worry, because Fraser's Property has a cash and deposits of 2.7 billion, which is more than enough to cover the debts that will be maturing this year. In terms of interest coverage, Fraser's Property interest coverage is at 3 times with a debt to equity of 70.2%. So, I mean, for Fraser's Property, their gearing increased slightly was due to the redemptions of its 3.95% perpetual back in August 2022. So, okay, so some of the questions you might ask is, why am I suggesting 2 to 3 years duration bonds and why hospitality sector? So, I mean, like I've mentioned at the beginning of the seminar, because Fed are expecting for rates to trend down starting next year, which I think in this current meeting, there's a dot plot and, okay, not the dot plot, there's a summary of economics projection. So in the economics projection, Feds are expecting the rates to reach 5.1% this year and start to taper off gradually next year and reaching the range of 2% in 2025. So, I mean, this presents opportunity for investors to capture the bonds, that I mentioned earlier, which are currently trading at a higher yield to lock in the rates, essentially, before it starts to taper off in a later period. So secondly, why hospitality sector in particular? Well, because hospitality is positioned to recapture the recovery in traveling, and this recovery has already been starting to reveal itself in their financials that I mentioned earlier. So our strategy approach is more towards recovery visibility on the hospitality sector, while also trying to snag up on some bonds that are showing good financial records and are offering decent yields before the rate starts to fall off at a later on periods. Okay, so I mean, this is more towards people in the webinar. So for people who are interested to know more about bond prices, you're able to head on to our P2 platform, whereby you're able to source for the indicative pricing of the bonds that you're looking for. Then next, our bond desk also have a bond screener, which is a very good tool that everybody can utilize to filter down onto the specific bonds that they're looking for in terms of currency or the yield to maturity or the coupon rates that they're looking for. So in terms of recent bond issuance, we also have a recent bonds tab, which shows all the recent bond issuance on the specific date itself. So, I mean, the highest, the latest record, the latest issuance would be at the top of the table. Then subsequently, it will continue flows down in terms of the dates. And also, we also have a bond article page whereby we will do a write-up on mainly most of the new bond issuance, as well as currently trending fixed income news. Then we'll try to do some coverage and you're able to get your information from there as well. So with that, that'll be the end of the seminar. And if you'd like to get in touch with us, you're able to contact the bond desk, or you're able to call in, basically. So, thanks everyone. And